Since the last weeks, FICO have been declining very strongly since the last results, more than 32%, and now it's back to minus 21% since the last top that was in 19 May. Okay, so in this video we're going to see if it can represent a good opportunity for your portfolio, if it's a good time to buy the company, or if you should wait, or maybe the decline of the company is really showing a big problem and you should avoid investing in this company, especially if you want to outperform the market for the long run. So the reason for this decline, it's mostly some federal housing finance agencies. They are questioning the FICO pricing structure for its score because last quarter they said that they will make price higher, like 40% higher. So it's a severe increase in price. So they are like searching for other solution, okay, to be more cost effective, because they think that FICO is a bit exaggerating on the pricing powers that they have, and they want to create some maybe new regulation. Now there is three main competitors in this. They want to potentially pass to two. So obviously the investor got scared by this, because if they lose this part of the market, FICO will have less revenue. So which means the valuation will be, for now, which is way too high. But the main problem, I guess, for the decline was the valuation. Okay, FICO was trading at a very, very high multiple. Okay, if we go here, you can see that now the value, we take the price to free cash flow. Now the price to free cash flow is around 60. Okay, it was at high to 76.8, which is very high. If you look at the median and the mean for the last 10 years, we were around 35, 36, the average around 38. If we take for 20 years, the average around 25, median 21, and 30 years, median 19, almost 20, okay? And if we take out this little one here, like median around 18. So the valuation is historically very, very high for this company. So that's explained most of the decline. So we'll see if it can be a good company, if it's a company that I have in my watch list, and at what price it's interesting to buy. So when we look at some key metrics, the growth, we have a revenue growing by 8% per year for the last 10 years, which is very good. The EPS, which is even more impressive, by 25% per year for the last 10 years. So that's why we had such a performance for the company, because they grew the EPS by 25%. And at the end of the day, the share price is correlated with EPS growth. And the free cash flow has grown by 20% per year for the last 10 years. So really good. They have, I will not say low level of debt, but they have very good level of debt. 2.9 net debt to EBITDA, which is good. Under 3, it's fine for me, okay? Interest coverage 9.57, over 8 is good for me as well. So the debt is fine. The margins are great. They are increasing. Operating margins, they almost tripled, okay, from 16% to 42%. Free cash flow margin from 13% to 36%, which is extremely good. Efficiency, return on equity on invested capital from 11% to 43%. Return on capital employed from 19% to 55%, which is extremely good. Here you can see some mistakes that a lot of people make for the return, okay, on capital. They will look at, let's say, only one data. You need to look at more. That's why I look at return on invested capital, return on equity, and return on capital employed, because sometimes one of the three will be very strange, okay? Sometimes it can be strange badly, sometimes strange positively. For example, here, if you look only at return on equity, or if you put only return on equity in your screener, you will not find this company because they have minus 53%. While if you were looking for return on invested capital, you will have something good, and return on capital employed is good as well. So don't only focus on one. It's not because the return on equity is negative that it's automatically bad, okay? Because return on equity depends on the equity. Maybe there is some problem here. Maybe there is the debt level make the equity negative. You don't really know. So you need really to be careful with this, to not focus on only one, and to check with return on capital employed, return on invested capital. Like this, you will have more, a better view on this. When it comes to the evolution of the financials, you can see we'll check the operating income. And you should see here on the operating incomes, and 2016, 2017, it's where it started like to really grow, okay, 20% per year. And before, if we go to 2007, you can see that from 2007 to 2017, it didn't do much, okay? It was pretty flat, 177 million, and here 148 million. So almost no growth for this time. And then from 2016, it's when the magic started to happen for the company, because they changed a little bit their pricing, their business model, and that helped them to really grow. On the top of this, so they increased their margin, okay, because the revenue grew less than the income. So the margin got higher. You can have here, you can see the operating margin. They really got higher, especially like now, like from 2020, 2021, you had a big pump, and it started like being a good trend from 2016, 2017 on the change of the business model. We can see as well that they're doing some serious buybacks, okay? For the last 20 years, they've been buying back 5% per year. And what is interesting to see here is if you just look at the last couple of years, since 2016, they bought back only 3% per year of their share. But if you look before, from 2006 to 2016, let's say, okay, they were doing 6% buybacks, almost 7% buybacks. And it's something that we really want to see, because before the stock was completely undervalued. So the management knew they were undervalued, so they were very aggressive with the buybacks. Now the valuation is very high, so they don't do a lot of buybacks. They still do, but they do way less, which is actually something very smart, because you don't want to buy back your own shares when the valuation is too high. So this is very good from the management, okay? The management did well here. When we come to look at some other ratio, like the financial health, you can see that the debt to EBITDA is pretty stable, okay? I will remove the share outstanding here. When we have the debt to EBITDA, it's very stable. It's a company which have like stable revenue growth. Like if you look at the way the revenue grew, it's very stable. Let me have a look here. You can see that even if you put quarterly, it's a very stable revenue growth here. It's accelerated here and very stable. So that's normal that a company like this will have higher debt, but it's under 3 net debt to EBITDA, so it's good. So at what price should we buy it? First, we want to see the price to free cash flow and have a look at what was the average, the median, and so on. And you can see the median for the last 20 years, 21. The median for the last 10 years, 35. So I will not be comfortable to put 35. I will pick something between those two, okay? I think something around 30, 27 should be good, because I don't want to put a valuation, multiple valuation, which is too high, because I like to have some margins of safety. The company is very good, but is not worth to pay too much for it. So I will go with 27 here. Okay, we'll do one after with 30. The free cash flow had to grow by, if the free cash flow grow by 23%, they do 3% buybacks, okay, and this is the current free cash flow. You will have 7.8% per year annual return, which is not really good, because I don't think 7.8 will help you to beat the market. I think if you want to beat the market, you need to aim for over 10%. I'm personally aiming for at least 13% when I do my DCF. So with this assumption, if you want to do 13%, you need to buy at $1,363. So the stock need to go down 21% to have the good price to buy. But to be honest, 23% free cash flow growth per year for the next 5 years, I think it's a bit high. Historically, it's been around 20. So I will take a little margin of safety and I will put 19. Okay, the free cash flow will grow by 19% per year for the next 5 years. I will still do 3% buybacks, because let's say the stock will stay pretty high in terms of valuation. So they will not go to 6 or 7%. I mean, if the stock decline, I will not be surprised that this go to 6% or 7%. But now, let's say that it will not have a big decline. So with 3% buybacks, a valuation of 27 price to free cash flow, it means that the fair value will be $1,156. So we need a decline of 33% to have our fair value. And if we buy now at this price, we'll do 4% per year. So for me, it's way too low. The company is on my watch list. I want to have a look at it. I will regularly have a look at it. I will start to deep dive into it to really understand perfectly the business and everything around. But for now, the price is still too high, even with the 20% decline we had in May. By the way, on Thursday, June 5th, we are opening again 20 spots to use margin. So you can register right under with the link in the video to join the waitlist. You will be informed when the launch will be done by email. We're opening 20 spots for second row of beta testers. You will have a huge discount for your for the access. You will never have this price again. Okay, now it's the last time we do such a huge discount. We added the screener. Okay, it's not yet finished, but on 5th June you will have a usable screener to add here. We started to add international stock, some company from China. We have now the quotation which are from China. We have quotation, for example, for Novo. Before we had only the US quotation. Now we also put the Danish quotation with the price in Danish crown, okay, with financials in Danish crown. Same for example, Evolution AB. We have it now from the Swedish stock exchange, so the price in Swedish crown, and the financial, the report is in euro as reported by the company. So this is what we've been working on the last month, the screener, and for the next months, we'll be working on the scoring of the company, okay, to help you first screen better and have some good scoring with good track record to become better investor, to pick better stocks and so on. And all of this is already available. And for people who will join on Thursday, so it will be open from Thursday to Sunday, approximately 20 spots available. You will have access to all the new features without paying more than what you already pay. So if you want to secure your spot with a very good price, with something which is already working pretty well, 30 years of financial history and so on, just register right down with the link in the description and go to the wait list, and you will receive an email when it will be open. I will see you in the next video. Bye bye.